sound of typical YouTube intro music fades out. Hey everyone, and welcome back to the channel where we demystify the markets and shine a light on unique trading situations. Ever wondered what makes a stock hard to borrow and why that term gets traders buzzing? Today, we're diving deep into Global Interactive Technologies, Inc., or GITS, a South Korean-based technology company with an eye-popping annualized cost to borrow exceeding 930%. We'll break down what that means and why it might land GITS on your watch list. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. GITS company logo/info card. Let's kick things off with a look at Global Interactive Technologies, Inc., trading as GITS. This is a microcap company in the communication services sector, specifically within internet content and information. Through its subsidiary, GITS operates and develops Faning, a digital fan engagement platform designed to support online fan communities in South Korea, fostering content discovery, sharing, and user interaction. With a market capitalization of just $7.02 million, it's a relatively small player. Looking at recent price action, GITS has seen some headwinds, closing down 6.64% today. Over the last 5 days, it's down 7.51%, and a more substantial 17.23% over the past 30 days. Volume has been light, with today's total coming in at only 22,400 shares, significantly below its 30-day average volume of 72,773 shares. That's a relative volume of just 0.3 times its average. What is cost to borrow and why it matters? Animated graphic explaining CTB. So, what exactly is cost to borrow, or CTB, and why do we care so much about it? Simply put, CTB is the annualized fee that short sellers must pay to borrow shares of a stock. When you short a stock, you borrow shares, sell them, and hope to buy them back at a low price later. The CTB is the interest you pay on those borrowed shares. It's essentially the price of admission for betting against a stock. When a stock becomes highly desirable to short sellers, or when the supply of shares available to lend becomes extremely scarce, these fees can skyrocket. We're talking well over 100% annually, and in some extreme cases, even on a daily basis. This high fee signals that demand to short is high, or supply to borrow is low, or both. Why this stock is hard to borrow right now? GITS CTB number 932.3% prominently. Now, let's tie that back to GITS. Our screener flagged Global Interactive Technologies, Inc. because it currently boasts an astonishing annualized cost to borrow fee of 932.3%. Yes, you heard that right, over 900%. With an estimated float of just 2.4 million shares, this extraordinarily high CTB suggests extreme difficulty in finding shares to borrow. This could be due to a significant existing short interest relative to that small float, or simply very few shares available from brokers to lend out. Imagine paying nearly 1,000% interest just to hold a position. However, it's crucial to understand that a high CTB does not automatically guarantee a short squeeze. It can also indicate strong conviction from short sellers who are willing to pay a premium to maintain their bearish positions, perhaps anticipating further declines for GITS. Squeeze mechanics explained. Animated short squeeze explanation. So, what is a short squeeze and how does it happen? A short squeeze occurs when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their potential losses. When a stock like GITS, with its near 932% CTB, starts to experience upward price momentum, those short sellers suddenly face immense pressure. Every dollar the stock goes up means their losses are growing, and they are still paying that exorbitant fee. This forces many to cover their shorts, meaning they buy shares in the open market to return the borrowed shares. This forced buying creates a feedback loop, driving the price even higher, trapping more short sellers, and fueling the squeeze. A shrinking supply of borrowable shares, as strongly indicated by GITS's current CTB, can accelerate this process dramatically. Our internal composite squeeze score for GITS, which combines CTB levels, borrower supply, float size, and price momentum, currently sits at 42.5 out of 100. This is a moderate score, indicating some potential, but not yet all the ingredients for a full-blown squeeze. Dilution risk check. Text overlay, dilution risk, none detected. One critical factor to consider in any short squeeze thesis is dilution risk. Dilution occurs when a company issues new shares, increasing the total number outstanding and thereby reducing the ownership percentage of existing shareholders. In the context of a short squeeze, new share issuance can flood the market with supply, negating the scarcity that fuels the upward price movement even when the cost to borrow is high. This can effectively offset or completely negate a potential squeeze. We always check for this. For GITS, our recent scan found no recent diluted SEC filings such as SMINUS-1, SMINUS-3, or 424B forms in the last 90 days. We also found no recent reverse splits in our look-back window. This means there's no immediate new share supply visible from these common sources that could counteract a squeeze scenario. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show GITS chart with potential key levels highlighted. So, what should you be watching if GITS is on your radar? Given its minus 17.23% drop over the last 30 days and today's minus 6.64% change, any turnaround would need serious catalyst. First, a significant surge in volume. Today's 22,400 shares is far too low. You'd want to see GITS trading well above its 30-day average of 72,773 shares, indicating renewed interest and buying pressure. Second, strong upward price momentum that can hold above key resistance levels. Third, continued low availability or even fewer shares to borrow, which would likely push that 932.3% CTB even higher. Finally, any positive news catalyst related to Global Interactive Technologies Inc.'s failing platform or broader operations in the South Korean market could spark a buying frenzy. Right now, with a relative volume of just 0.3x average, GITS is quiet despite the extreme CTB, so caution is warned. Show GITS company info again. In summary, GITS Global Interactive Technologies Inc. presents an intriguing case study with its astonishing 932.3% annualized cost to borrow and small 2.4 million share float, especially for a company in the internet content and information sector operating the failing platform. While the CTB is extreme, its composite squeeze score of 42.5 indicates potential, but also that other factors aren't fully aligned for an immediate explosive squeeze. Remember, high CTB means expensive shorting but doesn't guarantee the shorts are wrong or that a squeeze is imminent. Keep GITS on your watch list if you're tracking hard to borrow situations, but always remember the risks involved in these volatile setups. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives into hard to borrow stocks, and let us know in the comments below what stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video. Our pro music starts.